We are now in the final month of 2022. If you have made it this far without panic selling, good for you. But if you had sold, well done on timing the markets. Anyway, before the year ends, we still have to face one final boss, and that is the last Fed meeting on December 13. This meeting is super important, not only because it will set the tone for 2023, but it's also because this might be the day where we could finally see the Fed starting to slow down rate hikes after furiously raising the rates for the better part of the year. So, in this video, I'll be discussing what we can expect from this Fed meeting and also try to answer the question that's on everyone's mind. When is the Fed going to pivot? Because if we know the answer to that question, we might be able to roughly guess where the market bottom is. So, without further ado, let's start right now. Throughout this year, the Fed has been raising rates super aggressively, bringing the rate from near 0% to almost 4% now. The reason they had to do that was because inflation was quickly rising until it reached a 40-year high. Of course, many people are saying that this was caused by the Fed themselves printing tons of money and mistaking inflation to be transitory, causing them to be too little and too late. But that's a topic for another day. In the last Fed meeting, some of the officials are now suggesting that they should slow down rate hikes soon, despite the fact that inflation still remains high. That's because whenever there's any change in interest rates, it will usually take a few months before it could finally affect the economy. Basically, the Fed is trying to aim for a soft landing, aka make inflation go down while trying not to crash the market. If they slow down too soon, inflation will go back up. But if they tighten too fast, they will accidentally crash the economy. When this news came out, everyone be like, what lah? The S&P 500 stopped crashing and started going back up. So hopefully you haven't missed the market bottom, yeah? A very important date to follow is on December 12th, where the latest inflation data will be released. Because right now, everyone is expecting that the inflation rate to continue its downward trend. If on that day, for whatever reason, inflation rate suddenly jump back up, the Fed will immediately be like, sorry guys, party's over. Continue the 75 basis point hike and the market will crash gao. Whether it will happen or not, you will just have to wait and see then. Then here comes the important question. When will the Fed pivot? To answer this, let's first define what a Fed pivot is. Some will say that the Fed pivot means that they are slowing down their rate hikes. If that's the case, we could see the Fed pivoting as early as this month. But according to Investopedia, a Fed pivot is where the Fed changes their monetary policy, aka changing from raising rates to cutting rates. For this, Powell has said that it's premature to think about pausing interest rate hikes. Basically, he'd be like, pivot your head lah. For the Fed to pivot, they need to start seeing inflation come down. And not just come down, yeah. Come down and remain low. That's because in the 1970s, even after inflation had come down, they weren't able to keep inflation low and it just went back up. Everyone be like, shit, here we go again. And the Fed wants to avoid this at all costs. Quick pause, did you know that the Webull app has quite a lot of features other than, just buying and selling stocks? For example, you can read up on important stock news in the news tab. Or if you go to the company tab, you can check out key financials and indicators here. For example, you can see that Tesla's earnings per share has been going up. Nice. Return on assets, return on equity, income statement, balance sheet, cash flow, and there's even a peer comparison too. Also, right now, their sign-up bonus is super generous. By just depositing 2,000 SGD in, buy one US stock or one ETF with a minimum transaction of 100 USD, buy one US option, or while maintaining a 2,000 SGD net account value for that 30 days, and you will receive a $150 cash voucher reward. So if you are interested, you can sign up to Webull using my link down below. With that being said, let's get back to the video. So realistically, what do we need to see before the Fed finally starts to pivot? According to the CNBC Fed survey, first, we need to see the core personal consumption expenditures index remained below 2.6% for 5 months. Basically, PCE is similar to the Consumer Price Index, in which both of them measure inflation. But while CPI gets the data from household surveys, PCE gets the data from businesses and corporations while taking GDP into account. And the Fed prefers using the PCE as it tends to be more reliable than the CPI. Right now, the PCE is at around 5.1%, which means that it is still very far from the 2.6% target. Second, we need to see unemployment rates go up to 5.3%. And no, it's not because Powell is evil and he wants to make people lose their job or anything. But maybe he does. Jokes aside, the reason they need unemployment rates to go up is because right now, when we have low unemployment rates, increased job openings, non-farm payrolls going up, everyone be like, what ah? Then they can continue to keep spending money, ultimately causing inflation to remain high. And third, we need to see GDP growth rate to go below -2%. And right now, we have jumped back to a positive GDP. And since consumer spending accounts for 70% of the GDP, it still shows that the Fed hasn't done enough to slow down inflation. So for now, it's still a little too early to talk about a Fed pivot. But here's a prediction. If we check the Fed Watch tool, the market is expecting the rates to peak by either April or May. Remember, right now, we are only at a 3.75% to 4% rate. So we could easily see another 1.25% rate hike before the Fed stops raising rates. Then, after that, the rate could only start coming down in either September or November. Will this happen? Maybe, maybe not. This is just a probability thing, yeah? So we will just have to wait and see. So when the Fed pivots, the market will go back up to the moon and everyone will live happily ever after, right? No, because there are now warnings about a potential recession next year. You know, a time where people are losing their jobs, pay doesn't go up, and the economy is shrinking. Will a recession come? It depends who you ask. According to Jim Cramer, he believes that the Fed could avoid a recession, which according to the inverse Cramer rule, a recession would definitely come. At the same time, some of the Fed staff are saying that the chance of a recession is just 50%, which is like saying, maybe good, maybe no, see how low? That's because on one hand, we have a few signs pointing to a possible recession. The most popular indicator would be the 2-year, 10-year yield inverting. You can see that whenever the line goes below 0, we will see a recession, represented by the grey lines here. Another indicator is that whenever the Fed raises interest rates too fast, there will be a recession. But on the other hand, GDP has gone up, consumer spending has gone up, consumer sentiment is going back up, unemployment rate is low, even the popular Sum Rule recession indicator isn't showing any signs of a recession yet. So there are conflicting signs of whether a recession will happen or not. However, even if we did enter a recession, many analysts feel that it will just be a mild recession, like Fitch Ratings saying that the US consumer finances are quite strong. So knowing all this, how should you invest now? Personally, I'm bad at timing the market, so I'll continue to stay invested. But there's always the usual group of people saying, the bottom is not here yet. Later the market crashes 50%, then you know. So let me show you some data. First, it has been shown that in 11 out of 12 rate hike cycles, the market has continued to go up. Second, even if a recession did come, it doesn't always mean that the market will crash. Historically, 6 months after the start of a recession, 82% of the time, the market had given positive returns. Third, if the recession doesn't come, it's even easier because the market started crashing back in November last year when the Fed first hinted that they will be raising interest rates in 2022. So if the Fed stops raising rates and if there's no recession, the market will start going back up. Actually, the Fed doesn't even have to stop raising rates for the market to go back up. Back in 1982, when the Fed guy, Paul Volcker, suggested that he may stop raising rates, the market immediately bottomed and start going back up. So with these few simple reasons, I will continue to stay invested. Yes, you can try to time the market by waiting for the Fed to pivot. But by the time they do so, it's too late already. So here's my suggestion. Continue to dollar cost average as usual. Market up, you buy. Market down, you also buy. One more thing, instead of keeping the money in the bank, transfer your money into the broker and keep it there. That's because 1. There might be a delay when you are transferring your money over. You wouldn't want to miss buying the bottom just because of some stupid delay, right? And 2. Some brokers like IBKR, Mumu Singapore, Tiger and Proyams lets you earn some interest off your idle funds. So anyway, that's all for this video. Hopefully you find it useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.